Well, thank you very much. It's a real pleasure to be back at EFL. It's been many years, as Clemens has mentioned. In fact, I think the last time was around 2011 or 2012 when I was here. And I've worked with many people here, in Clemens including, as well as Alphonse Weichenreiter, and of course Hans Werner Sinn has been a friend for many years as well. So uh, it's really something I'm very pleased to be able to have an opportunity to talk here in Munich, especially on a topic that I've been really following very closely over the past year, and that is U.S. tax reform. What I plan to do, and I think I'll uh, give you a bit of a highlight, is what I'd like to try to really go through what is a pretty complicated set of proposals in the end. But particularly, I want to focus on global implications of U.S. tax reform, and by focusing on the global implications, particularly with respect to investment, it's the corporate tax changes that I think are most critical, I think, in terms of how other countries are going to look at U.S. tax reform and how they're going to respond to U.S. tax reform. So I won't be spending a lot of time on personal taxation, although I'd be happy to take any questions you might have on it. I have read the conference report, as well as the original House plan, the Senate plan, all the various plans over time. There's actually 450 pages if you want to go through it. And I won't talk about every detail that's in it. In fact, I'm not sure I've absorbed every detail yet in the conference report. In fact, there's many businesses now that are all looking at what to do vis-a-vis their investment plans with respect to the United States. Multinationals deciding, should I put more money into Germany or should I put it more into United States? Canadian businesses are particularly perplexed about what should be the next steps with U.S. tax reform, given the amount of deregulation that's taking place and nervousness over a protective wall, that trade wall that is potentially built up with the United States. Many Canadian companies are asking questions: do I put my money into a market with 350 million people, or do I put it into another one with 35 million people? At one time, if I had a lot of access to that 350 million people from Canada, that wasn't a big issue. But now there's a double hit, in a sense, for many Canadian businesses, and they're really evaluating this right now. In fact, just to give you an example, yesterday I was at a conference in Montreal that Ernst & Young had. All the accounting firms now go by acronyms, so it's EY. And although when you say EY, people say, "What are you talking about?" But except for Deloitte, all the large accounting firms now just use acronyms. But EY had this event, and someone from one of the major pharmaceutical companies operating in Montreal said they are reevaluating what to do because of the significant changes with the U.S. tax reform that particularly will impact on intellectual property and research and development. And they're deciding where they should put their money next around the world, and how they deal with some of the issues that U.S. tax reform is bringing up. So I'm going to go through a lot of the corporate tax changes. I'll talk about investment impacts, financing impacts. I want to discuss intangible income because I think it's quite important as well. And I will talk about what countries might want to consider vis-a-vis changes to their own tax system in response to U.S. reform. So I'm going to begin with a bit of a review, not of all the provisions. I wasn't about to present 450 pages of material to you, but in 2 slides I'm going to give you kind of a very quick overview of what the reform is. Some of this you probably might know, if you follow this in various newspapers. As well known, the federal rate is being cut from 35% to 21%. This is not a staged reduction in corporate rates, which is often many countries do, partly to reduce some of the windfall gains to old capital. Instead, this is a one-time cut. So as of January 1st, 2018, the federal rate in the United States, instead of being 35%, is 21%. And if you include the corporate income taxes of the state governments, which are deductible, it's a reduction of around 39.1% to approximately 26% overall corporate income tax rate, once you include the average state corporate income tax rates in the United States. Depreciation. The United States has had this love affair with what's called bonus depreciation, and this is expensing for up to a certain amount of capital expenditures, usually in assets of less than 20 years recovery. So it tends to be machinery and equipment. And in fact, it started in 2001. It was introduced at 50%, and then 2004 to 2007 it was abolished, and then it was brought back in during the recession at 50%, then increased in 2010 to 100%, then brought back down. And in fact, in 2017, the bonus depreciation rate was 50%, and it was being phased out by 2020. It was going to be 40% in 2018 and 30% in 2019, and then by 2020 eliminated altogether. And I'm going to show you some of these impacts when you think of it relative to what was already legislated in the system. What the Tax Acts and the Tax Cuts and Job Act does in the United States is to bring in expensing. So basically, bonus depreciation back to 100%. That will last until 2021 and after 2022, and then after that it'll be phased out by fifth each year, and then by 2027 it'll be eliminated altogether. Also, research and development expenditures that were expensed are now going to be amortized after 2025 in the plan. And I'll get back to some of these phase outs and other things towards the end, and in terms of the instability of the U.S. tax reform. Another very important change is with respect to interest expense, and I'll come back to this quite a bit. The U.S. did have a rule on interest limitations where foreign parties or related parties that were investing in the United States would face a sort of like a thin capitalization rule where they would not be able to deduct all their interest. There was a safe harbor where if you had sufficiently low indebtedness, it didn't affect you at all. But the new interest expense rule in the United States, what's important about it is that actually it's now very general. It applies to every corporation operating in the United States, whether it's a foreign-owned company operating in the United States or a domestic company operating in the United States. So it's a generalized interest limitation. And it's based on 30% of adjusted earnings. And you might think of adjusted earnings, at least until 2021, it will be the equivalent of earnings before the deduction of interest, taxes, depreciation, depletion, and amortization, or EBITDA, as accountants like to call it. And then after 2021, it will be 30% of EBIT, adjusted earnings, or some other adjustments, small ones, but effectively think of it as EBIT, which is earnings before the deduction of interest and taxes. What's important about this, and I'll say some more things about this later, there's no safe harbor, unlike the previous rules. So in other words, it applies no matter what your indebtedness. If your earnings aren't very much, you could end up losing some of your interest deductions. And there is an indefinite carry forward for the interest deductions. And as usual in most countries, there's an exception for small businesses of less than 25 million, and also certain industries are exempted, some public utilities and finance particularly. There's also a change in intercorporate dividends. Because of the lower corporate income tax rate, the U.S. has always had a tax on intercorporate dividends when there's not significant ownership in the affiliate. So if it's from uncontrolled dividends, there's a higher tax rate, and if it's one where there's some control, partial control, but not full control, then there's a lower tax on those dividends. They basically kept the same level of tax on it, but because they lowered the rate, they changed the various exemptions. But that actually gave some additional revenue in their forecasts. Intercorporate, small business expensing of $1 million, phased out over $2.5 million, and then a really important change is the introduction of cash accounting for gross receipts for companies with less than 15 million in revenues, and that's a huge benefit actually to small companies in the United States. Another important limitation is with respect to net operating losses. There used to be a carryback of 2 years and forward for 20 years. Now the carryback is eliminated except for farm losses. And by the way, Canada at one time used to have no deduction for operating losses. This is like many decades ago, after the Second World War. But the one area they always gave a deduction for was for farming. So there's something very special about the agricultural community in many countries. But under the new rule in the United States, losses can only be written off up to 80% of taxable income in any 1 year. And there's an indefinite carry forward now, but no carryback, as I've mentioned. And then the corporate alternative minimum tax, which did have an impact on many firms with cyclical profits, risky profits, was applied at 20%. Also, if they had special write-offs, they would end up paying the corporate alternative minimum tax. That's now been repealed altogether. So that's another important change. And these are, if you look up the revenue numbers in terms of the $1.5 trillion of revenue loss in static estimates, under the corporate tax, these are the big items in terms of revenue impacts. There's a whole bunch of other ones dealing with insurance and et cetera, but these are focusing mainly on the biggest items. Now, the other set of very important changes with respect to international income, and I think here is probably the most fundamental change that's occurred in this tax reform for the United States, is the whole treatment of international income. The United States is now adopting a system which I think is familiar to you here in Germany. It's familiar to Canadians. In fact, it's familiar to most OECD countries these days. In fact, I think all OECD countries. And that is when a parent earns profits abroad and they bring it back as dividends, there's an exemption given for dividends in terms of the home country tax. So only the host country is presumed to tax that income, and when the dividends are brought back, it's tax-free. The United States has gone from its deferral system where they tax dividends coming back to the United States, giving an indirect tax credit for corporate income taxes, and as well as a tax credit for withholding taxes. Now now those dividends are now exempt, very similar to what other countries are doing. They did change the qualification for what's an affiliate. It's going to be based on ownership of 10% of the value of shares in the affiliate. Voting shares won't matter anymore, which is a distinction they had previously. So that's a major change, because effectively they've gone from this system of applying taxes to all remitted income coming back to the United States and giving an exemption system. Americans love calling it territoriality. I really dislike that word entirely, because when I think of territoriality, that is providing a full exemption for all foreign source income. For example, Hong Kong does that, and so I never really understood why a dividend exemption system all of a sudden becomes territoriality, because foreign capital gains still are subject to tax, royalties, interest, everything else, with a tax credit given for withholding taxes in those cases. There's also a one-time transition tax on accumulated earnings and profits that are held by foreign affiliates since 1986 up to now. The tax doesn't have to be paid immediately. It can be paid over 8 years. It's paid whether you bring back that money or not. It doesn't matter. It's really a transition tax to kind of capture the tax that should have been paid on those dividends had it been remitted back to the United States. And it's 15.5% on cash assets and 8% on illiquid assets. A lot of those earnings and profits are invested abroad, and they won't be brought home. But the big question, of course, are cash assets and the extent to which cash assets will be brought back. And then, of course, some companies might, and I'll get to this later on, might take on more debt finance in their affiliates abroad, and that would allow for more repatriation of earnings and profits back to the United States. And already we're starting to see announcements like Apple's announcement the other day, and I forget the exact number, I think it was $55 billion that they're planning to bring back home to the United States. Now there's a number, because of the dividend exemption system, the U.S. said, well, we've got to protect our corporate tax base as well. And so they're introducing, besides the earnings stripping rule I mentioned earlier on interest limitations that will apply to international income, whether it's outbound or inbound, but it also will be relevant to other aspects of the tax system. And I'm going to go into more detail later about some of the implications of these proposals, but one of them is the base erosion anti-avoidance tax. This is for inbound. What's different about this is it's not just interest, but it'll apply to royalties and fees. It's kind of a minimum tax to be paid on that, and it starts at 10% for the next 5 years, and then will be increased to, up to 2026. Trying to keep the dates in mind for all these timing changes is really quite a challenge. And then it'll be 12.5% after 2026. And there's also some really important changes that were made on hybrid debt, which I know a lot of Canadian companies have had with their U.S. operations to effectively get a double interest deduction, and that's going to be disallowed actually in terms of using hybrid debt coming into the United States as well. Then two other very important ones, which I know the German government and the European governments have been particularly focused on in terms of potential implications for them and potential WTO actions, which I'll talk about later, is the global intangible low income, or GILTI tax. This is a new one, but what's really important, it's really a tax on intangible income defined as more than 10% of the tangible assets. So it's sort of like a presumptive return on tangible assets at 10%, and so it's a tax that you pay on the difference between your revenues, or your net revenues, and your kind of like this 10% rate of return on tangible assets, and that's an accrual tax, so it doesn't matter whether you remit the income back to the United States or not. You pay this tax. Initially, it'll be 10.5% and until 2026, and then it'll go up to 13.125%. And a tax credit is only given for 80% of foreign taxes, which might raise some OECD issues in terms of not giving a full credit. The other tax is FDII. I love these acronyms. The Foreign Derived Intangible Income Tax. This is kind of like a quasi patent box treatment for R&D in the United States that's sold to non-related parties abroad, and it's a tax that will effectively give a concessionary rate of taxation in the United States for research and development. So both the GILTI and the FDII taxes are really ways of trying to create more incentive for research and development in the United States, as well as holding intellectual property in the United States and discouraging it from abroad. And this is actually a very important change, which I'll come back to as well. So what are the implications of all this? So one of the things that we do now in Calgary is, in fact, I've been doing it now for over a decade, going back to 2004, but we model actually 92 countries around the world in terms of marginal effective tax rates. And our marginal effective tax rates are more than just manufacturing. We do manufacturing and service sectors, forestry as well. We also do oil and gas and mining and as non-renewable sectors, although we don't do 92 countries, we do much more selective groups, so they're not included here. And in these calculations, what we do is we calculate the annualized value, as you might want to think of it, of corporate income taxes, asset-based taxes like capital taxes that we had in Canada, but in other countries as well, like taxes on fixed assets in Japan, and transfer taxes like real estate transfer taxes, stamp duties, these types of taxes, as well as sales taxes and capital purchases, which is very important. In fact, the United States has a retail sales tax at the state level on which is a very significant tax on purchases of capital in the United States, and it's roughly 7 to 8 points of the marginal effective tax rate that we calculate. So it's not a small number. In fact, we're the only ones that actually incorporate this. And in fact, I've given presentations down in the United States because U.S. Treasury and the Congressional Budget Office really includes retail sales taxes. They try to include property taxes, which are not easy to measure, but they always ignore the retail sales tax, which is a bit strange because it's really a very important tax as a sales tax on capital purchases, just like other transfer taxes can be. And so we incorporate all those, and it's done. We work closely with the Department of Finance in Ottawa vis-a-vis. We provide theory, they provide us data, or we do some of the data ourselves and share it with them. And we also do this for 4 major assets: structures, machinery, inventories, and land. And we do it for a various number of industries, which I'll show you later on. So these are the calculations that we've done. This is for 2017. In fact, we have a major report that's being refereed right now and should be coming out soon. But we've estimated this for all the different countries. And in the paper that I prepared for this, I gave you all the 92 marginal effective tax rates across the world that we estimate, including the transfer taxes, but that go back to 2010. Although without transfer taxes, we go back to 2005. We just haven't updated everything for that case. But as you can see here, the U.S. reform will, leaving aside bonus depreciation for a moment because it was being phased out and a lot of companies weren't really taking it seriously anymore by 2018, the U.S. reform does lead to a very dramatic reduction in its effective tax rate on capital from 34.6% to 18.8%. If you include bonus depreciation of 2018, it's 30% down to 18.8%. Still a very major reduction in taxes. And then I gave you some countries, basically the other G7 countries, and I don't know, maybe my numbers on Germany might be different than some of your numbers. We include the municipal corporate levies as well here for Germany and some others that we include. But it's, as you can see, Germany will be certainly higher than United States as of 2018 by a significant amount. Italy is very low, mainly because of the allowance that they give for new equity financing, which is deductible. An imputed cost of new equity financing is deductible from the tax base for Italy, which gives them a much lower marginal effective tax rate as a result. And Japan is high because there's this big fixed tax on fixed assets that people often don't incorporate in the analysis. But these are the various rates. United Kingdom, by the way, includes the stamp duties, which again, a lot of people don't include. So this kind of gives you an idea that the U.S. reform really does have a very dramatic impact on the marginal effective tax rate as of 2018. And I'll show you some numbers, but you might think of it about half is due to the corporate rate reduction, and the other half is due to expensing. Actually, it's a little bit more towards expensing relative to the corporate rate reduction. Just to give you an idea, how does this compare to regions of the world? As you can see, United States, the new marginal effective tax rate is going to be roughly equivalent to the GDP weighted average in Africa of the countries we do, somewhat more than the simple average, certainly less than the other parts of America. Brazil, by the way, has a very high effective tax rate on capital, and of course it's a big country, but also a number of other Latin American countries have relatively high effective tax rates. It'll also be much lower than Asia, Oceania, and that's because actually India and China have relatively high effective tax rates in capital, particularly India, although India has brought theirs down sharply this year in 2017 due to the value-added tax reform there. But it's still a pretty significant number with all the different levies they have. And as you can see, relative to Europe, if you take the simple average, the American rate is, the European rate is still on average still a little bit below the the new American one. But the weighted average, it will be less, and that's because Germany and France have relatively high marginal effective tax rates. And then for the Middle East and North African countries, the U.S. will still be higher. So it's kind of mixed in terms of how regional responses might take place, and it also depends on the trade exposure that different countries will have. Obviously, Mexico and Canada are, because of all our significant trade with the United States, we are very concerned about these numbers. But on the other hand, you know, if you're in Middle East and Northern Africa, I doubt you're going to be as worried. Or let's say some parts of Asia, Oceania, a little less worried about the implications of U.S. reform, at least from an investment attractiveness point of view. Now, just to give you an idea of the what changed a lot vis-a-vis the various sectors of the economy in the United States, the biggest changes were in forestry, where there's a very big manufacturing component. Manufacturing, you can see, drops by almost a half. And that's because there's a lot of machinery in manufacturing that's going to get expensing as a result. We're going to change the utility numbers. I think they're a little bit too low here. There's certain public, not all public utilities, but certain public utilities that actually don't get expensing. So that number will go up a bit, but we haven't been able to do the full analysis yet to knock out some of the utility sector. But leaving that one aside, you can see that the big changes are going to be in transportation, communications, manufacturing, forestry, and other services, where you have quite dramatic reductions in marginal effective tax rates as a result. Our oil and gas number here, we haven't done mining yet, but our oil and gas number, we include the impact of royalties at the margin. If you had a cash flow royalty system when all expenses were deducted, as we have in Canada for a number of our provinces, and in United Kingdom and in Norway and some other countries, at the margin, the royalty would not be a tax on investment, because you're able to write off all your costs of the project against your revenues, and so you basically pay a tax on your inframarginal rents. And but when you have a royalty system, which is based on the value of revenues, you tend to put a tax on even at the margin that impacts on investment decisions, and that's included in this analysis. Anyway, so as you can, these are the numbers. We did drop out oil and gas in the aggregate numbers because we don't do that for all 92 countries, as I mentioned. Now, what's interesting is that I call this kind of like U.S. reform as roller coaster taxation of investment. You know, if you start looking at the bonus depreciation and the expensing provisions, you know, they keep changing the numbers all the time, every year. And so, if you start at 2017, when there was 50% 50% bonus depreciation in 2017, the marginal effective tax rate was roughly 28%. For 2018, now with 100% expensing, it drops to below 20%, stays that way for the next 5 years, and then starts its climb up when expensing is eliminated by 2027. And so this gives you an idea about the difference between the statutory rate reduction impacts and the expensing impact as a result. But it also suggests that this is a highly unstable reform when it comes to taxation of capital. And of course, I'll come back to this later on about what I think is going to happen to U.S. reform over the years. But I think most people sort of look at this reform, well, in the first 5 years, I think we have a good idea what's going to happen. But who knows what Congress is going to do after 5 years with this reform. And I'll come back more to that point later on. Now, let me say a few things about some of the very specific changes, which I think are really important and particularly could have important impacts in other countries. The interest limitation rule, the U.S. is basically going to be using two types of earning stripping rules, one based on, as I mentioned, on EBITDA, and the other one based on EBIT. What most people would normally think that once you hit the limit, your cost of capital is going to rise for investments. Actually, that's not true. And what's going to happen is that even though once you hit the limitation, let's say 30% of EBITDA, you do lose interest deductions at the margin. And so your debt costs become more expensive because you can't write off interest over and above the 30% limitation. And so that does raise the cost of capital for investment. But on the other hand, if you're investing in something like machinery, which is short-lived, and a lot of depreciation, you also create a lot of earnings that can allow you to shelter some more interest expense. And that actually can drive your marginal effective tax rate down, not up. And in fact, some numbers that we've done earlier in a paper about 8 years ago, we had shown that with earnings stripping rules based on EBITDA, like the one you have in Germany, actually is biased towards machinery and equipment because of this treatment of this ability of being able to invest in machinery that creates a lot of earnings before the deduction of depreciation, and that can allow you to shelter more interest expense as a result. So EBIT actually, which is tighter, doesn't provide the same sort of benefit compared to EBITDA for short-lived capital. There is still a sheltering aspect because you can generate more earnings with investment before interest and taxes, but it's not. But it doesn't give you the same advantage vis-a-vis depreciable capital. And so the U.S. rule actually, I know that J.P. Morgan had told me this. The number of companies that are going to be affected by the EBITDA-based earnings stripping rule, at least under their current estimates, is probably less than 10% of firms in the United States. And when you look at the aggregate data, if you just take the average, it's not going to really be very impactful, at least for now. Of course, when you go through a recession, or if you're in a cyclical downturn, it does become more meaningful. And of course, as interest rates go up, as one will expect, with monetary policy tightness in the coming years, the interest limitation rule will become more important. And as a firm, by some point, you may be hit by these debt rules, maybe not at every point in time. And even though you can carry forward the interest expense, write it off at a later time, it doesn't give you necessarily that. You still lose the time value of those deductions. So it is important. But I do want to make that point because it is really relevant that just because you have a limitation on interest deductions doesn't mean you cause the cost of capital to rise. You actually could cause the cost of capital to fall. And for those of you, if you look at the appendix in the paper I sent, I went through the derivation of that to provide you the user cost of capital when you do have an earnings stripping rule. Whether it's EBIT based or EBITDA based, I give you two formulas for that. So this is actually a very important point. And so I've always argued if you are going to have an earnings stripping rule, and I think you should have a safe harbor, as in a number of countries have done, I would argue for an EBIT-based one rather than an EBITDA-based one because it's less distortionary across different assets. The base erosion anti-avoidance tax has raised a lot of questions about whether it's going to interfere with trade and everything else. There were some major changes made as the plan, as the tax plan developed in the United States. The important thing is that it doesn't apply to the cost of goods sold. But what happens is that it's effectively a minimum tax, and you pay this BEAT tax if your income plus disregarded payments, which is basically, as I mentioned, interest, royalties, and fees, is more than your regular corporate tax payments, although not quite your regular corporate tax payments because you can only write off 80% of your investment tax credits in calculating whether you pay this BEAT or not. So it's not quite your tax. And I gave you a little bit of a formula here. So the BEAT tax, let's say at the rate T, 10% in a year. Y is your taxable income, B is the disregarded payments. You pay the BEAT if that, and this only applies, by the way, for companies, inbound investments coming into the United States, companies making inbound investments in the United States. You pay this BEAT tax if it's more than your corporate tax, but adjusted for only 80% of investment tax credits being calculated as opposed to all your investment tax credits. So it gives you part of your investment tax credits are ignored. So what I show is, with the BEAT, actually the BEAT is 10%, not 10.5 here. That's a typo. But if B is more than 1.1 income minus 8 times your investment tax credits before 2025, if your disregarded payments, are more than 1.1 of your taxable income minus 8 times your investment tax credits, then you pay the beat. And then after 2025, when you have a different rate of beat, which is 12.5%, it'll be a different calculation. It will be actually tighter, as you can see, when you're going to end up paying the beat. In talking already to tax planners in Canada, the view is that the beat probably won't be as effective as one thinks. So there's two ways, obviously, of avoiding the base erosion tax. One is to blow up your taxable income in the United States. But given the interest limitations and loss limitations, you may want to do that anyway. And so your Y goes up, and if you allow your income to go up, then you can avoid the beat payment altogether. But the other thing is, if you want to try to reduce some of the disregarded payments, there are a couple of strategies to do that. One is to change your transfer pricing methodology, where you include some of the benefits in the cost of goods sold rather than having an explicit price like a royalty that is paid. Now, I've worked in transfer pricing cases in the pharmaceutical sector, and I can tell you there's a lot of that that's done. A lot of the benefits are put into the cost of inputs being sold into another country, chemical inputs to create a drug, and includes all the support given by the group, to the subsidiary in a particular country. And so if you can put some of your benefits into the cost of goods sold, you can avoid the beat disregarded payments, because that only applies to interest and fees and royalties. The other way of doing it is to not have a transaction, but to instead have an agreement between the subsidiary and the parent to have a shared type of investment, like a joint venture. And if you do that, effectively, you can use a profit split for calculating your transfer price. But also, under research and development, it's quite acceptable for you to do a cost-sharing type agreement, and that won't be, where there's no markup, and that will avoid the beat altogether as well. So that's why there's a view is that probably the beat is not going to be that significant for many industries. However, the one I did hear could be subject to a lot of difficulties over the beat is in the financial sector. Because of the regulations that operate in the sector, it's going to be harder to take some of these other strategies to avoid the beat. So from what I've heard, the financial sector is probably the one that's going to have the most difficulty dealing with the beat. Guilty and fiddy. Well, I've already talked about this as accrual-based tax and the incentives on holding intellectual property, and the use of defining intangible income really is the excess of your income over the rate of return on your tangible assets. Now, of course, the question is, what is incentives impacts does this have? Well, certainly in terms of intangible income, where you put your intellectual property, if to the extent the firm will have to pay the GILTI tax, they're more likely to keep their intellectual property held in the United States than in another country, and this will be very important. And by the way, one of the comments that was made about the GILTI tax, because Ireland has a 12.5% corporate income tax rate, and if you take 80% of that, which is what foreign tax credit will be given, that's 10%, and that's where the 10% beat tax rate came from. It was because of the Irish corporate income tax rate, because many American companies were putting intellectual property into Ireland. So that's kind of clear. The question is, what incentive will this have on tangible assets invested abroad? And one of the points that I've made in the resource tax literature at several times in various pieces I've done is that when you're putting a tax on something where, let's say, it has differential rates of tax, like royalties, where you have a royalty on high rates of return, let's say like more than 10%, and then a lower royalty rate, profit rate tax on less than 10%, what you can show is that if the business can invest in some more capital, in other words, broaden the capital base a bit, it can create a stream of deductions in the future that will be, for tangible assets, would be equal to 10% of the capital cost of that tangible asset. Now, it may depreciate over time, but effectively what it means is that you can get a tax savings for every dollar involved, which will be equal to actually the rate of return times the corporate income tax rate divided by the depreciation rate plus the discount rate. That's your present value of actual tax savings that would be involved with this investment. That can actually drive your marginal effective tax rate to being very low or even negative for investments when that happens. And so what the GILTI tax will do is that it'll actually encourage companies to put more tangible assets in certain countries if they want to try to avoid the GILTI altogether, in order to build up that exempt part of their income so that they won't have to pay the GILTI. The same thing applies to the FDI, but in reverse, where there'll be an incentive to put more tangible assets into United States in order to build up more exempt income, and then you're not, you want to put less intangible assets in the United States so that you can get more of a concessionary rate on your intellectual property. So it's a rather interesting impact on tangible assets as a result. Let me say a few final comments about the overall reform in the United States. If you sit back and ask, is this a good or a bad reform on the corporate tax side, I would say it's got mixed results. Certainly, it does reduce the intertemporal distortion, and economists might argue that's a good thing in terms of growth, etc. It does, however, create more differences across industries and assets especially because of the expensing provision, but some of the other things that are introduced in the system. And it also increases the, while it's a little less known, it may or may not raise the distortion between risky and non-risky assets. Because of the cancellation of the corporate minimum tax, that tended to hurt risky type investments because you'd end up paying taxes when your income is not very good, but then you pay a lot, more tax when your income is doing well. In the case of, with the cancellation of the AMT, but now with the introduction of new loss restrictions, that actually puts risky investments more offside relative to compared to risky investments, at least compared to a system where you didn't have a limitation, the 80% limitation on the use of losses. And then the system also will reduce the incentive to use debt financing, which of course is a point that many people have talked about since the 2009 financial crisis as a relatively positive thing. On the simplicity side, I would probably argue that there's not a lot of simplicity with this change. I didn't go through the pass-through treatment of corporations, which are mainly more the limited liability companies and provisions relevant to that. Especially it applies at the small business level or medium-sized company level, although some large companies use pass-throughs as well. But there are very complex rules involved with that, and I'm sure there's going to be a lot of changes that are going to be introduced down the road to deal with, I think, a very complex area there. I could just imagine the wheels of the financial sector in the United States developing new derivatives around some of the changes that have been developed, creating lots of borders between corporations and pass-throughs, and then within pass-throughs between service income and passive income and active business income. And Americans are really good at tax planning. And then of course the GILTI and the FDII taxes, the BEAT, they all introduce new complexities that haven't been there before, despite the exemption given for dividends, which the previous system was actually very complex, trying to tax remitted dividends coming into the United States. Then as far as equity, well, my view of the corporate tax is mainly a story about horizontal equity. If you have the similar tax across all business activities, no matter who derives the income individually, one would like to try to have horizontal equity. Vertical equity is much more difficult to understand because you have different owners of corporations, etc. So I won't say very much about that. I think the equity issues are more interesting in terms of the U.S. personal tax reforms, which do vary. Now there has been some work done on impacts. We've done some analysis on the impact of U.S. investment. In fact, there's some empirical work that we've done with our marginal effective tax rates. Actually work quite well in explaining investment around OECD countries. And in fact, we find that manufacturing investment will rise, at least in the longer run, by about 8% in the United States due to these changes. There's been work done by Larry Kotlikoff and his people using actually our marginal effective tax rates. He's got an interesting general equilibrium model where he has 17 regions around the world, and he really models capital inflows across all the countries, which is more sophisticated than a lot of open economy models, because he takes into account reactions of other countries and not just kind of assumes an open economy for one particular country. And what he finds actually is that the U.S. reform will lead to about a $2,500 increase in per capita incomes. Wages will go up roughly over 10 years by about 5%, 5% for low-skilled workers, and about 6% for high-skilled workers, etc. So certainly, I think one of the things, and even the IMF now said this yesterday, is that world growth will be higher as a result of this U.S. tax reform. So we do benefit in other countries. It's not necessarily a negative. I do expect significant capital flow inducements where U.S. companies will bring cash back into the United States, in my view, likely to buy down debt, but also use it for investment. They've already made announcements for bonuses, and I think that was part of the quid pro quo with the Trump administration and the Congress, that they would make those kinds of announcements. But I think that also with the anti-abuse rules, there will be a real desire to push costs out of the United States, and of course that will have an impact on other countries in terms of lower corporate taxes. As U.S. Anyone with operations in the United States, whether it's a foreign controlled company or a U.S. company, in the past, your game was put costs in the United States and keep profits out of Canada, or out of the United States. Now it's going to be the reverse. Put profits in the United States and push costs out to other countries, especially with these interest limitation rules that are introduced, and et cetera. So that's actually quite important to Germany and other countries, because that could have an impact on revenues. And so I do expect some profit shifting as a result. And of course, the intangible income, certainly there will be less incentive to hold intellectual property outside the United States. The impact on tangible assets, so, could actually go the other way. So what will countries do? Well, I know in Canada we're starting a debate about this. In fact, the Prime Minister at Davos yesterday said, well, we're going to do anything. So we'll see how long that lasts. But I do know that Canadian businesses are very engaged now, looking at their supply chains and what they're going to do vis-a-vis their investment decisions in relative to Canada and the United States, and I'm sure that's happening in a lot of other countries with anyone with significant U.S. operations. In some cases, it won't matter at all. In other cases, it'll have an impact. Certainly, base erosion, I think, is one to watch out for. So it may induce some countries to look at lowering the corporate income tax rates if they're particularly on the high side around the world. And actually, a lot of countries now are 30% or less. So there may not be that movement on that much movement on the corporate income tax rate as one thinks, but certainly countries with high corporate income tax rates may, and with a lot of American relationship, may be worried about this base erosion effect particularly, and look at lowering the corporate rate, or they will themselves introduce their own base erosion type rules. Maybe we'll have more of a war on interest deductions, maybe other types of costs and fees, transfer pricing, etc., to try to balance off some of the changes in the U.S. that's going to induce companies to push costs to other parts of the world. Certainly with the U.S. expensing provisions, they're only temporary. They're not, they're over 5 years. Some countries might decide, rather than lowering corporate tax rates, actually it might be better introducing temporary investment tax credits or accelerated depreciation that would be phased out along with the U.S., and that might be another strategy to consider. And then, of course, another one to think about, especially with the GILTI tax, is countries may be using more grants rather than tax credits for research and development, because grants don't get clawed back by a tax in the United States when it comes to U.S. Ownership of intangible income in other countries. And I forgot to mention, intangible income is not just research and development this will affect, it will also be mining. Oil and gas was knocked out of the GILTI and the FDII rules, but not mining. So actually we'll have an impact on mining intangible income. And then we'll have to see what's going to happen on WTO. What kind of challenges might arise, and whether countries, one way of reacting to reform will be to challenge some of the changes, particularly on the international tax side. I'm not a lawyer, so I'm not going to get into the debate, but I do know one thing, is that could take 3 to 5 years to sort out, even any WTO action. That won't be immediate in terms of what happens. The Americans have said they have not done anything against treaties, so you can imagine there will be a fight over this. And of course, right now, there's a whole, with the Trump administration, there's not a great love of the WTO anyway. So this might just feed into what they want to eventually do, which is to challenge the whole basis of the WTO, something that we have to worry about more in the future. So let me conclude. I think U.S. corporate tax reform will have a very significant impact on decisions on companies and where they decide to put their money, where they finance their capital with debt particularly, and also where they're going to put their intellectual property. So the rules of the game have changed. And anyone who look at the U.S. now, the tax planning is completely reversed. It's been completely upended, whereas I said before, the role of any international tax planning in the past was put costs into the United States and keep profits out of the United States, and now that's completely reversed. And that's why companies are going to be looking at their tax structures over the next while. I also think it's going to be there's still a lot of instability associated with this reform, leaving aside change in political control that could happen easily in Congress and the presidency and WTO actions. Some of the provisions are being phased out, like expensing. A lot of the corporate tax ones are permanent, unlike the personal income tax ones, and that's because of the budgeting process in the United States, which I didn't get into in detail. But also some of the rules are very complex, and I also think something like the interest limitation, 30% of EBIT, is very tough, and I suspect there'll be a lot of pressure to change that in a few years' time as we get closer to that stage when it moves from EBITDA into EBIT. And of course, if you get a recession in the U.S., there'll be a lot more complaints about the interest limitation rules as a result. And the whole treatment of pass-throughs is which I did not go into, is very complex, and I suspect there's going to be a lot of changes with respect to the treatment of pass-throughs in the United States. But I do think some major things are going to stick, particularly the dividend exemption system in the United States. And also, I don't think the U.S. will ever go back to a 35% corporate income tax rate. Maybe 25, maybe a higher rate from 21 with a different government. But I think if you look back, even the Democrats and Obama's administration itself had recommended corporate income tax rates in around 27, 28% at that time. So no, I don't think anyone's going to go back to the 35% rate in the United States. That will likely stay the same. So we are in a different world, and it will be interesting to see how countries evolve. And all I can say is that accountants and lawyers who work in taxation are going to be very busy this coming year. Anyway, thanks very much.